Welcome to The Explainer. Today, we're unpacking something that sits at the absolute heart of the global financial system. Think about it. What's the ultimate currency in investment banking? Well, it's not the dollar, the euro, or the yen. It's actually trust. Without trust, the whole system literally grinds to a halt. But how do we measure something so invisible?
Imagine trying to actually quantify the exact financial damage of bad corporate behavior. Sounds kind of impossible, right? Like, if a bank acts unethically, how do you capture that in a spreadsheet? How do you really know if an institution is safeguarding your money, or if they just have this culture of cutting corners? Well, surprisingly, the financial industry has developed a standardized way to track, measure, and put a literal price tag on these ethical failures.
Okay, let's dive right into our scorecard for today. We're going to cover the anatomy of trust, measuring corporate business ethics, tracking the bad apples, whistleblowers and safety nets, and finally, the true cost of misconduct.
All right, starting off with part 1, the anatomy of trust. Now, I know what you're thinking. Reading through global regulatory standards sounds a bit dry, right? But we're going to look at them as an investigative scorecard. Think of the SASB framework as essentially a nutrition label for corporate behavior. Just like you check a label to see what ingredients are actually in your food, investors use these exact standards to reveal the true ingredients of a financial institution's culture, their risk management, and their accountability. It basically forces transparency on things that, traditionally, a lot of corporations preferred to keep quiet.
The standard brilliantly splits this into two distinct areas. On one side, we have the macro level, right? Business ethics. This looks at the institution as a whole, how the entire corporate entity behaves in the market. Then, on the other side, we have the micro level, professional integrity. This focuses squarely on the individual employees and the decision makers. To truly understand the cost of misconduct, you really have to measure both.
Moving on to Section 2, measuring corporate business ethics. Let's look at those macro-level offenses. And what's really fascinating here is that these are the exact accounting codes used to track massive corporate breaches. We aren't dealing in vague terms here at all. The SASB standards mandate that institutions report on specific categories of misconduct. This gives investors a crystal clear, standardized view of a firm's actual ethical track record.
And here is the core metric, Code FN IB 510A.1. This metric totals the sheer financial hit from legal proceedings. So we're talking about fines, settlements, and restitution tied directly to things like fraud or market manipulation. And here's a totally critical detail. This number explicitly excludes the firm's legal defense costs. It only captures the actual penalties and settlements. So this is the pure, unfiltered cost of getting caught doing the wrong thing.
Just to keep our definitions crystal clear, let's look at how these crimes are actually categorized. Under institutional business ethics, we see the massive, market-shaking offenses: fraud, insider trading, antitrust behaviors, and market manipulation. But when we flip to individual professional integrity, the focus shifts to the personal level. Things like breach of fiduciary duty, meaning they didn't act in your best financial interest, negligence, and malpractice. The scale is obviously different, but the impact on client trust, it's identical.
Which brings us to Section 3, tracking the bad apples.
So, how do institutions track their own risky employees? Well, transparency works at the individual level too. Under Code FNBIB 510B.1, banks have to disclose the percentage of their licensed employees and identified decision-makers who actually have a record of investment-related investigations, consumer complaints, or regulatory proceedings. Seriously, as an investor, you can literally see the percentage of decision-makers handling your money who possess a rap sheet of past issues. It's an incredibly powerful metric for assessing a firm's internal risk culture.
But, not every single dispute ends up in some massive courtroom battle. Code FNIB 510B.2 counts the non-judicial disputes, specifically mediation and arbitration cases related to a breach of the duty of care. What's really fascinating here is that the standard requires the bank to break this down by who they were fighting with. Was the opposing party a client, an employee, or someone else entirely? It tells a really vivid story about where the friction inside a firm is actually coming from.
And of course, we have to connect this all back to the money. Code FNIB 510B3 demands the total monetary losses stemming specifically from these professional integrity failures. Because just like corporate fraud, an individual broker's malpractice or negligence carries a massive, quantifiable price tag. All these individual payouts add up, and they heavily impact the institution's bottom line.
Moving to Section 4, whistleblowers and safety nets. So how does an institution actually try to stop the bleeding and catch these issues before they turn into millions of dollars in legal losses? Well, the crucial point is that it's not enough for a bank to just say they have a hotline. Code FN-IB510A.2 requires banks to describe their specific safety nets. Investors really need to know, is the whistleblower hotline actually managed by an unbiased independent third party? Are there tangible incentives for employees to report violations? How exactly are these tips submitted and protected? A robust whistleblower policy is often the very first and best line of defense against systemic ethical failures.
Furthermore, institutions must detail their overarching approach to ensuring professional integrity. This means active, required disclosures about how management implements codes of ethics, how they transparently mitigate conflicts of interest, how they train their staff, and crucially, how they conduct internal investigations into malpractice. The whole idea here is proving that the firm actively prevents misrepresentation and ensures fair dealing, rather than just waiting to react when things go wrong. And finally, Section 5, the true cost of misconduct.
We have the data, we have the metrics, but what is the ultimate bottom line for investors in the global financial system? I want you to imagine putting your life savings or maybe your company's pension fund into a financial institution. You wouldn't invest a dime if you couldn't verify their track record, right? These SASB metrics give the market a standardized, unflinching look at the exact cost of a firm's ethical choices. It literally takes these vague, fuzzy concepts of culture and turns them into hard, comparative data.
The SASB standard itself actually says it best. These measures are important both for preserving an entity's license to operate, as well as for attracting and retaining clients. Tracking monetary losses and regulatory complaints isn't just an exercise in accounting. It is absolutely a fundamental mechanism for safeguarding long-term trust and protecting shareholder value. Because at the end of the day, without integrity, the entire business model collapses. Which leaves us with one incredibly important question to consider. We can track the fines, we can count the complaints, and we can force institutions to disclose their monetary losses. But does putting a precise dollar amount on misconduct actually stop the bad behavior? Or for some massive institutions, does it just turn ethical failure into another predictable cost of doing business? It's a massive question, and one every single investor needs to ask when looking at these scorecards. Thank you for joining me for this explainer, and remember to keep questioning the data.